Welcome, and thank you for joining Oaktree Specialty Lending Corporation second fiscal quarter 2025 conference call. Today's conference call has been recorded. At this time, all participants are in a listen-only mode, but will be promoted for a question-and-answer session following the prepared remarks. Before we begin, I want to remind you that comments on today's call include forward-looking statements reflecting current views with respect to, among other things, future operating results and financial performance. Actual results could differ materially from those implied or expressed in the forward-looking statements. Please refer to the relevant SEC filings for a discussion of these factors in further detail. Oaktree undertakes no duty to update or revise any forward-looking statements. I'd also like to remind you that nothing on this call constitutes an offer to sell or solicitation of an offer to purchase any interest in Oaktree Fund. Investors and others should note that OCSL uses the Investors section of its corporate website to announce material information. The company encourages investors, the media, and others to review the information that is shared on its website. Now, I would like to introduce Clark Corey, OCSL Head of Investors, who will host today's conference call. Mr. Corey, you may begin.
Thank you, Operator. Our second quarter earnings release, which we issued this morning, along with the accompanying slide presentation, can be accessed on the Investor section of our website, oaktreespecialtylending.com. Joining me on the call today is Armen Panossian, Chief Executive Officer and Co-Chief Investment Officer, Matt Pendo, President, and Chris McCown, Chief Financial Officer and Treasurer. I'll now turn the call over to Matt to provide an overview of our performance during the quarter and a couple of updates with regard to our capital structure. Matt.
Thanks, Clark, and thank you to everyone for joining today. Adjusted net investment income was $39 million, or 45 cents per share, compared to $45 million, or 54 cents per share in the first quarter. Our net asset value was $16.75 per share versus $17.63 in the prior quarter. These results reflect ongoing challenges with a few portfolio company investments, which we have been and continue to work towards restructuring or exiting. We moved several of these investments to non-accrual and took additional write-downs. As a result, investments on non-accrual status increased to 4.6% and 7.6% of fair market value and cost, respectively. This compares to 3.9% and 5.1% in the first quarter. On the positive side, we made progress in resolving several investments on non-accrual, including exiting our loan position in SVP Singer, where we received proceeds totaling $5.7 million, which was consistent with our mark as of December 31st. We've also seen some increased sales activity in Avery, a luxury mixed-use building in San Francisco. Sales picked up in the second half of calendar year 2024, and the trend has continued thus far into 2025. Proceeds from sales go to repaying our loan, enabling us to redeploy capital into new income-generating investments. During the last quarter, we received proceeds totaling 10% of our cost basis, and we expect to receive additional repayments next quarter. In addition, in April, we received nearly $100 million from repayments on debt investments, all of which were realized as small premiums as compared to our March 31 valuations. Now turning to our dividend. In line with our new dividend policy we announced last quarter, our board approved a base dividend of 40 cents per share and a variable supplemental dividend of 2 cents per share for the second quarter. With regard to our balance sheet, we successfully issued new unsecured bonds that mature in 2030 to refinance our existing bonds that matured in February 2025. Additionally, shortly after quarter end, we successfully amended our senior secured revolving credit facility, extending its maturity and reducing the interest rate from SOFR plus 2% to a range of SOFR plus 1.75% to 1.875%. We appreciate the support of our bank group and believe that lower interest expense and associated fees will have a favorable impact on our net investment income. With these positive changes to our capital structure and our leverage at its lowest level in over 3 years, We have ample dry powder for new investments as we navigate this volatile period. Before I turn it over to Armen, I want to remind you about the meaningful steps we took to more closely align our interests with shareholders. Earlier this year, we amended our incentive fee structure by implementing a total return hurdle, and Oaktree purchased $100 million in OCSL shares and a meaningful premium to the share price, which provided us with additional capital to deploy into our pipeline. Also, in July of last year, we reduced our management fee to 1% on all assets. We believe these actions demonstrate our commitment to shareholders and to enhancing the long-term earnings power of the portfolio. I'll now turn it over to Armen to provide more detail on non-accruals and our investment activities.
Thanks, Matt. I'll start with additions to our non-accruals. 2 companies were added to non-accrual status during the quarter. The first was Mosaic Companies, a designer, distributor, and retailer of specialty wall and mosaic tile, floor tile, and slabs. Mosaic operates 3 distinct business segments, and the sponsor had initiated sale processes for all 3. Unfortunately, each of these segments are expected to be impacted by tariffs, which affected the sponsor's efforts to sell. 2 of those processes were paused during the quarter. The sale of the 3rd segment closed shortly after quarter end, resulting in a meaningful cash paydown of approximately 50% of our total position. Pro forma for the repayment, we took a conservative approach in valuing the remaining assets, leading to a markdown of approximately 76% on the unsold portions. Despite being placed on non-accrual, the material cash recovery reflects progress in our efforts to manage and resolve the position. We are actively working to sell the remaining 2 business segments. The second addition was SiO2, a manufacturer of a hybrid material that combines glass and plastic for medical use in diagnostic tubes, vials, and syringes. Our prior position in the company was restructured in August of 2023. In this quarter, we placed a restructured loan on non-accrual due to the company's continued cash needs. We marked down the loan by about 69% at quarter end. The company recently signed a new contract and is pursuing several other opportunities and license agreements. We remain focused on supporting the company in these strategic initiatives. Although it's not new to our non-accrual list, Dialyze is another investment where we took a significant markdown. We placed the company's first lien term loan on non-accrual in the December quarter, given the company's ongoing cash needs. We continue to be actively engaged with management and other stakeholders to evaluate the best path forward, but unfortunately, the situation has not materially improved. And this quarter, we marked the loan down by about 76%. While we're clearly not pleased with how SiO2 and Dialyze have trended, these 2 positions now represent less than 1% of the portfolio at fair value. Turning now to investment activity for the quarter. We committed $407 million of capital across 32 investments, consisting of 24 new borrowers and 8 existing borrowers. This compares to 13 investments totaling $198 million in commitments last quarter. The weighted average yield on our new debt investments was 9.5% versus 9.6% in the prior quarter. Increasing portfolio diversification remains a focus as we took the number of positions to 152 from 136 last quarter. We continue to emphasize investments at the top of the capital structure, and consistent with the first quarter, approximately 84% of the portfolio was invested in senior secured loans, including 81% in first lien loans. To mitigate risk in the current environment, we are prioritizing investments in larger, more diversified businesses that have the financial and operational ability to withstand uncertain times. As of March 31st, the median EBITDA of our portfolio companies was approximately $158 million, a $16 million increase from the prior quarter. The leverage in our portfolio companies was steady at 5.4 times, well below overall middle market leverage levels. The portfolio's weighted average interest coverage based on current base rates declined slightly to 1.8 times compared to 2.1 times last quarter. Looking at our second quarter originations, I'd like to highlight 2 noteworthy loans we made to Vantiv and Barracuda. The healthcare sector remains a strong focus for us given its critical need and sustainable outlook. Vantiv is a global leader in the development and manufacturing of capital equipment and consumables for both acute and chronic dialysis therapies. As a recognized innovator, Vantiv holds the number 1 position in the non-clinical peritoneal dialysis market, commanding approximately 73% market share. This financing facilitated Carlyle Group's acquisition of Vantiv, structured as a $2.5 billion first lien term loan and a $450 million revolving credit facility. Oaktree provided $425 million of the term loan, which carries a coupon of SOFR plus 5%, along with $77 million of the revolving credit facility. OCSL was allocated $61 million of the total deal. We also like service providers with recurring cash flow models and made an investment in Barracuda, a provider of cloud-enabled email data and network cybersecurity solutions for middle market and small to mid-sized businesses. This financing sits alongside the company's syndicated first lien and second lien term loans, and proceeds were used to bolster the company's liquidity position. Oaktree led this transaction and provided $100 million of the total $200 million term loan, priced at SOFR plus 6.5%, with OCSL receiving $15.5 million. We believe these transactions highlight the strength of Oaktree's deal sourcing platform and our capacity to participate in larger scale opportunity, advantages we believe set us apart from other market participants. I'll now turn to an overview of exit and repayment activity during the quarter. Investment exits slowed in the second quarter, totaling $279 million, primarily driven by fewer sales within our liquid portfolio. As you may recall from our remarks last quarter, we took advantage of strength in the public credit markets late last year and sold certain investments that we believe were fully valued. Now, I will turn the call over to Chris to discuss our financial results in more detail.
Thank you, Armen. In our second fiscal quarter ending March 31st, 2025, we delivered adjusted net investment income of $38.7 million, or 45 cents per share, as compared to $44.7 million, or 54 cents per share in the prior quarter. The decrease was primarily driven by lower total investment income, partially offset by reduced interest expense and Part 1 incentive fees during the quarter. Adjusted total investment income in the quarter declined $9.9 million compared to the prior quarter, primarily due to a decrease in interest income resulting from a smaller average investment portfolio, the impact of placing new investments on non-accrual status, and declining reference rates. Net expenses declined $3.8 million from the prior quarter, driven by a $2.4 million decrease in interest expense due to lower outstanding borrowings and lower reference rates on our floating rate liabilities, and a $1.5 million decrease in Part 1 incentive fees, net of fees waived, reflecting the impact of the total return hurdle. Now, moving to our balance sheet. Our net leverage ratio at quarter end was 0.93 times, down from 1.03 times last quarter. As of March 31st, total debt outstanding was $1.47 billion and had a weighted average interest rate of 6.7%, including the effect of our interest rate swap agreements. This is up from last quarter, primarily reflecting the impact of refinancing our 3.5% fixed rate bonds that matured in February with new bonds that mature in 2030. In connection with issuing the new bonds, we entered into an interest rate swap agreement translating to a coupon of SOFR plus 2.19%. Unsecured debt represented 65% of total debt at quarter end, up from about 59% last quarter. We have plenty of dry powder to fund investment commitments with liquidity of approximately $1.1 billion. This includes $98 million of cash and $1 billion of undrawn capacity on our credit facilities following the recent amendment that Matt described earlier. Unfunded commitments, excluding those related to the joint ventures, were $273 million, approximately $252 million of which can be drawn immediately, as the remaining $21 million is subject to portfolio companies meeting certain milestones before the funds can be drawn. Our target leverage range remains unchanged at 0.9 times to 1.25 times. We are currently at the low end of that range due to a combination of successful investment exits, Oaktree's $100 million equity investment in the March quarter, and our prudent approach to deploying capital given market volatility. Turning now to our joint ventures. Together, the JVs currently hold $440 million of investments, primarily in broadly syndicated loans spread across 54 portfolio companies. During the second fiscal quarter, the JVs again generated attractive annualized ROEs, which were approximately 10.6% in aggregate. Leverage at the JVs was 1.3 times, up slightly from last quarter. In addition, we received a $700,000 dividend from the Kemper JV. With that, I would like to turn the call back to Armen to provide some color on the market environment.
Thanks, Chris. Before opening the call up to questions, I'll provide some brief commentary on the market environment. Since the end of the second quarter, we have experienced some of the most volatile public market conditions since the pandemic in March of 2020. There is significant uncertainty surrounding the trade environment, including what new tariffs may arise, potential retaliatory measures from other countries, and how long these policies will remain in place. Despite the wide range of potential outcomes, we believe we can make the following observations with some certainty. Despite an optimistic outlook for a pickup in M&A activity earlier this year, activity has been slow and is likely to remain that way until we have more clarity around the economic outlook. We expect many lenders will be more cautious around capital deployment as they focus on the health of existing portfolio companies. In this environment, companies that were once supported by easy credit and low interest rates are now grappling with tightening liquidity, rising borrowing costs, and disrupted supply chains driven by global trade upheavals. It will be a couple of quarters before tariffs roll through the supply chain and impact portfolio company performance, so it's too early to assess the real impact now. That said, well in advance of the actual tariff announcements, we were considering their potential impact on existing and prospective investments. This heightened focus factored into our underwriting and risk evaluation, and we are proactively selling investments within our liquid portfolio that we perceive to have more exposure to negative impacts from tariffs. We are also focused on further diversifying our portfolio by selectively investing in companies we believe are well positioned to deliver attractive returns given market uncertainty caused by tariffs, as well as inflation and high interest rates. Recently, there has also been an uptick in demand for capital solutions or rescue financing, which could benefit managers like Oaktree that have significant experience and expertise in this area. Historically, in periods of market volatility, our firm-wide DNA has enabled us to capitalize on opportunities while others are sidelined, and we have the dry powder to do so, again, if appropriate opportunities arise. In closing, we believe OCSL is well positioned to navigate the current market environment and to deliver attractive risk-adjusted returns to our shareholders over the long term. We appreciate your participation on our call today, and now we will take your questions. Operator, please open the line.
Thank you. We will now begin the question and answer session. To ask a question, you may press star, then 1 on your telephone keypad. If you're using a speakerphone, please pick up your handset before pressing the keys. If at any time your question has been addressed and you would like to withdraw your question, please press star, then 2. At this time, we will pause momentarily to assemble our roster. The first question comes from Finian O'Shea with Wells Fargo. Please go ahead.
Hey, everyone. Good morning. First question, did you lean into any liquid markets, structured finance, or syndicated loans in April?
Hey, Finn, it's Armen. We were a little active, but not very, because we were then and continue to be concerned that the tariff situation is not resolved. And so what happened in April was, yes, it started off with a sell-off in high-yield bonds, senior loans, to a lesser extent in structured credit. But there's been a rebound, in the back, half of April. And so we've taken more of a measured approach, given that recovery.
Okay. It was helpful. And just a second higher-level question. Armen, you mentioned, remaining focused on the larger and diversified businesses. I think that's been the language or narrative for a while. Can you hit on, high level, how, successfully you've been effectuating that? Are you out there finding adequate issuers that fit within your box on a credit and structure perspective for direct lending, or is this a challenge? And then sort of part B there, the losses experienced are, what's the sort of overlap? Are they generally smaller EBITDA, or do they overlap with that sort of core focus? Thanks.
Yeah. Good question. So in terms of size, Finn,
the market ebbs and flows. So late last year, when the markets were pretty strong and wide open from a banking perspective, we saw spreads tightening in broadly syndicated loans. We saw spreads tightening in high-yield bonds. And we saw new issuance in senior loans, creation of CLOs, and we saw tightening in direct lending as well. And in the larger borrower segment, we found that, or the borrowers found that they could get better pricing and looser legal terms from the broadly syndicated loan market versus direct lending. So it was, I would say, it felt a little bit more challenging, or the trend did not feel so great for the, ultra large cap, the 150 million plus EBITDA category for new deals. What didn't feel so great in the back half, or the fourth calendar quarter of last year. With some of the volatility we've been seeing in the markets, though, in the last month and a half, we are seeing a pullback in new issuance activity from the banks. And so we are seeing a return of some larger borrowers into the direct lending market, post-Liberation Day. And so the pipeline from that perspective is, I would say, on the margin better for issuing direct loans to very large borrowers. With that said, M&A deal volume is not as robust as we would like it to be overall as a market. Now, the reason for that is in the fourth quarter, after President Trump was elected, there was, I would say, some positive feelings about where the market would go and where rates would go. President Trump generally at that time was considered to be somebody who would lean on lower rates, would lean on deregulation, and those would be good things for deal flow and the transaction of sponsor-to-sponsor LBOs. Now, so there was a lot of activity, at least in terms of discussions, late last year and early this year as to, hey, 2025 issuance is going to be very strong and M&A volumes will be strong. But the tariff announcements have thrown a wrench in that, and it just seems like private equity sponsors generally are reticent to do deals pending kind of what's going to happen with these tariffs, because it leans on higher rates, it leans on more inflation, and all of that is sort of bad for valuation multiples. So there is I think a somewhat of a pause happening right now in two respects. One is private equity sponsors doing new deals, and two, corporate borrowers that have some level of tariff-related exposure, i.e., part of their supply chain runs through a non-U.S. market, or part of their sales go to a non-U.S. market. We're seeing that there is a pause in building up of inventory, a pause in CapEx spending, and given that backdrop, I would expect to see continued sort of reservations around deal activity for a few months at least. So that's kind of the current condition around deal flow, large cap, but the deals that are getting done, so high quality businesses that are somewhat insulated from tariff impacts that are still being LBO'd, and there have been some announcements in the last few weeks. So deals are happening, it's just at less of a rate. Those deals are getting done more frequently in the direct lending market rather than the broadly syndicated loan market. So we are engaged in those situations. Our pipeline for the quarter so far, for this quarter that we're in so far, is actually pretty good, just given some of that pullback from the banks. So we feel good about that condition. To answer your second question about the markdowns, no, look, the markdowns are not in large cap sponsor lending. The markdowns, unfortunately, it's been the same names for a few quarters now, for a couple of years now, that have kind of weighed on performance. And there isn't anything thematic about them, but other than mid last year with Pluralsight, which was a very large LBO that had some issues which I think we've discussed in the past and has been pretty well known in the market. Other than that one situation, the rest of them are sort of idiosyncratic situations where just businesses have not executed the way they should have. In the case of SiO2, a business that was doing incredibly well during COVID, took a lot of that profitability and spent it on new R&D that didn't pan out, unfortunately. And so, that's not really a large cap issue or a big versus small business issue. It's a deal where the execution around that technology just did not meet expectations.
Okay, thank you.
Thank you.
The next question comes from Melissa Whittle with JP Morgan. Please go ahead.
Good morning. Thanks for taking my questions. Really trying to discern sort of run rate NII, given the markdowns on the portfolio, and the changes in non-accruals. It seems like with some stabilizing base rates, this could be sort of what we could expect in a given no changes in base rates, this could be a run rate level NII. Is that fair to say, or are you seeing other things happening in the portfolio that could impact that?
Hey, Melissa, it's Chris. Thanks for the question. I'll get us started, and if Armin or Matt want to chime in, please feel free. I think a couple things we're focused on. We mentioned in our prepared remarks that we finished the quarter at 0.93 times net leverage, so definitely kind of the low end of our range and where we've been operating historically. Our average portfolio throughout the quarter was a little bit lower versus prior quarter. So we're as Armin mentioned, going to be patient around deployment, but over time, we are mindful of the fact that we're lowering our leverage range than where we've been operating. And then I think the other focus, and I think Matt mentioned it in a couple of his comments, just around working through some of these situations on non-accruals, turning those into cash producing assets. This is definitely a continued focus of ours.
And I think Melissa, Matt, the other area we continue to focus on is the JVs, and putting more assets in there, running leverage a little bit higher there. They invest mostly in BSL, so those are it's relatively more easy to deploy there than in some of the private assets that the sales cycle is a little bit longer. So that's just the other point I'd make.
Sure. And I mean, to that point on leverage and then deploying within the joint ventures, obviously this quarter it seems very, very different from even the March quarter. When we look at sort of the repayment levels that you've seen in the portfolio and exits, repayments and exits over the last 3 quarters, they've been pretty sizable. Should we be expecting any slowing of repayment activity during this period of volatility, or would you expect that to remain pretty elevated?
Melissa, this is Armin. I could take a crack at that. So a couple things. In terms of liquid credit, in the back half of last year, especially the fourth quarter, as the markets were pretty tight, we actually we're just generally a net seller of liquid credit, and so we actually delevered the JVs as a result of that. I think given the volatility in the last 4 to 6 weeks in the public markets and our anticipation of further volatility in those markets, given what I would expect would be a challenging tariff backdrop for a while, I would expect that we will find some opportunities to deploy into the joint ventures and increase their leverage again. We're looking for good deals that are, or good companies that are trading discounted, and we don't think it's there yet. They traded off 2, 3, maybe 3.5 points, in late March and into April, and they've recovered maybe half of that point move. And if you look at high yield bonds, the spreads had widened to 435, 440-ish during that time frame. They're now back to sort of 375. They are pretty volatile, though, quite sort of up and down. But we think that as performance starts to show up in the second calendar quarter this year and into the third, there's probably going to be volatility in the public credit and equity markets that we think we could take advantage of for the JVs. In the case of private credit, we actually have had some exits since the end of the quarter. So I think those are more idiosyncratic, not really reflective of necessarily a tightening credit story. It was just situations that resolved. So I think our repayments for the quarter are not going to be immaterial. I think they will be up for the quarter end of June. I think they'll still be significant enough. But yes, I think your instinct is correct that if the markets are volatile, that generally speaking, repayments, refinancings should slow down, and I would expect to see that over the coming quarters as well.
Thanks very much.
Thank you. Again, if you have a question, please press star, then 1. The next question comes from Paul Johnson with KBW. Please go ahead.
Thank you. Thanks for taking my questions. Just on the kind of run rate question of income, just looking at the portfolio yield this quarter, I think it was down 50 basis points or so. But if I take a quick average of just kind of the debt portfolio yield, quarter over quarter, it looks like it's down a little over 100 basis points. So I'm just curious, is there any kind of, one-time stuff that's flowing through there, is this yield, I guess, that we have today reflective of kind of what you think the portfolio should generate going forward?
Yeah. Hey, it's Chris. Appreciate the question. I think a couple factors. I think looking at sort of the quarter-on-quarter decline in interest income, part of that is just due to reference rate declines. In the December quarter, rate sets for about half the book were based on 9/30 base rates. So those, reset at the end of December in light of the rate cuts that happened in the fourth calendar quarter. That played through, in the March quarter. So that's part of it. And you're as far as the quarter-on-quarter decline in yield, you're seeing from the 10.7% reported last quarter to the 10.2% this quarter. Majority of that, about 30 basis points worth, was due to the impact of the new non-accruals, which we've discussed, and a little bit of just I'll call it lingering timing with respect to reference rate reset, and also some spread compression quarter on quarter. So I do think that where we're at now is a decent run rate yield on the book.
Okay, thank you for that. And then you partly answered my question here, but on the JV, the 10.6% ROE, is that a net ROE as opposed to like an operating ROE on the JV?
That's looking at the NII of the JV. I should say the NII plus the coupon interest on the subordinated note.
Okay, because that's pretty close to what you're generating on the balance sheet. So it sounds like you may find some opportunities to increase leverage there and put some investments into the JV. So with leverage, I guess, what do you think you could potentially get the JV to in terms of an ROE over time?
That's, I think, going to depend on the opportunity set. I mean certainly, getting back up into the call it the the 11-12% context, I think is achievable. But will ultimately depend on the opportunities that we're seeing there.
Appreciate it. That's all for me.
Thank you. This concludes the question and answer session. I would like to turn the conference back over to Clark Corey for any closing remarks.
Thank you, operator, and thank you all for joining us on today's call. A replay of the earnings call will be available in approximately 1 hour, and you can access that on the investor section of OCSL's website. Please feel free to reach out to me and team with any questions you may have. Thanks again for your participation and support.
The conference has now concluded. Thank you for attending today's presentation. You may now disconnect.